I want you to think about something for a moment. Not a war, not a headline, a transaction. In March 2023, the UAE settled an LNG shipment 65,000 tons from Abu Dhabi to China's CNUC. Not in dollars, in Chinese yuan. It was not front page news, no press conference, no speech, just a transaction. And that transaction may have been one of the most significant financial events of the decade, because the UAE is not Iran, the UAE is not Russia, the UAE is not a sanctioned pariah state trying to escape dollar pressure. The UAE is one of America's closest partners in the Middle East, home to Al Dhafra Air Base, home to U.S. naval support activity, a country that has purchased billions in American military hardware and maintained deep financial ties with Washington for 50 years. And they settled oil in yuan. I'm the stat guy. Let's follow the money. To understand why this matters, you need to understand what made the petrodollar system so durable for so long. It was not just Saudi Arabia's agreement in 1974. It was the network effect. Every country that priced oil in dollars needed dollars. Every country that needed dollars had to hold dollar reserves. Every country holding dollar reserves had an incentive to keep the system going. It was a self-reinforcing loop. And for 52 years, that loop held. The loop breaks when countries that have the most to lose from breaking it decide to break it anyway. That is what the UAE just showed us. Here's the data that most commentators are not connecting. The UAE processed over $400 billion in trade in 2023. It is the world's fourth largest re-export hub. When the UAE starts settling even a fraction of that trade in non-dollar currencies, the ripple effects are not theoretical. They move through the system. And the UAE is not alone. Let me show you what has happened across the global trade system in the past 24 months. India settled Russian oil imports in rupees at significant scale. After the 2022 sanctions, India's Russian crude imports went from negligible to over 40% of India's total oil imports. The payments, rupees, not dollars. Brazil and China, the world's ninth and second largest economies, entered a direct trade settlement agreement in March 2023. The dollar eliminated from the world's largest South America-Asia bilateral trade relationship. Saudi Arabia, the nation whose 1974 agreement created the petrodollar system, has opened negotiations for yuan-denominated oil sales to Chinese buyers. And in June 2024, they did not renew the 50-year petrodollar agreement with the United States, the most consequential non-renewal in modern financial history. In May 2025, ASEAN finance ministers and central bank governors met in Indonesia and agreed to develop a framework for settling external transactions in local currencies, specifically to reduce dollar dependency. By 2025, 97% of trade within the Shanghai Cooperation Organization, which includes China, Russia, India, Pakistan, Iran, and the Central Asian republics, was settled in local currencies, not dollars. The dollar's share of global foreign exchange reserves has declined from 71% in 1999 to 57.3% in 2024, a 14 percentage point decline in 25 years, documented by the IMF's own COFR database, not opinion, measurement. None of these countries announced they are abandoning the dollar. None held a press conference to declare the end of dollar dominance. That is not how monetary transitions work. Monetary transitions happen the way Ernest Hemingway described bankruptcy, gradually, then suddenly. We are in the gradual phase, and I want to show you exactly what the gradual phase looks like in the data, because understanding the gradual phase is the only way to position yourself before the sudden phase arrives. And your stack exists for the sudden phase, but you need to understand the gradual phase to know whether the sudden phase is approaching. Now let's talk about what this means for physical silver at $76 an ounce today. I want to stop and acknowledge something before the analysis. Silver hit an all-time high of $121 per ounce in January 2026. Then it pulled back nearly 40% to the mid-70s. If you bought near the top and you're watching this, I'm talking to you specifically. A 40% pullback in a structural bull market is not a refutation of the thesis. It is a feature of silver's characteristic volatility. In 2011, silver fell from $49 to $26 in 5 months, a 47% decline before the next structural leg. What has not pulled back, what has continued its steady structural development while the silver price was doing what silver prices do, is the de-dollarization data. The petrodollar suppressed silver for 52 years, not through conspiracy, through mechanics. And when global dollar demand is artificially elevated, when every nation on earth needs dollars just to buy energy, the dollar stays strong. And when the dollar is strong, the price of silver in dollar terms is compressed. Take those artificial dollar flows away even gradually, and that compression lifts. Silver was $5 an ounce in 2003. It hit $49 by 2011, a 900% move during the last major dollar confidence crisis. It hit $121 in January 2026, a new all-time nominal high as the structural forces we have been tracking accelerated. And today, silver sits at approximately $76 an ounce, which means it has given back 37% from its January 2026 peak. And gold sits at approximately 4,160. The gold to silver ratio is currently approximately 63 to 1. That means it takes 63 ounces of silver to buy 1 ounce of gold. In April 2025, just 12 months ago, this ratio hit above 100 to 1. Silver was historically spectacularly undervalued relative to gold. That level has only been seen 3 times in modern history: 1991, the early 1990s recession, and March 2020. Now, from that 100.1 extreme in the 12 months that followed, silver gained approximately 148%, while gold gained approximately 56%. The ratio compression from 100 to 63 is silver's 148% gain, speaking in mathematical language. But here is the important question. The question I want you to sit with before we go to the de-dollarization connection. If silver rose 148% in the year after the ratio extreme from roughly $30 to $121, what happens to silver in the ratio compression event that follows a genuine de-dollarization acceleration, not a temporary monetary stress event, a structural one that has been building for 25 years? The historical answer from 1979 to 1980, when monetary stress was genuine and structural, is that silver went from $6 to $50. The ratio compressed from 38.1 to 17.1. At 17.1 with gold at 4,560, silver's implied price is over $280 per ounce. I am not predicting silver reaches 280. I never make price predictions. What I am saying with full data support is that the structural conditions driving the 1979-1980 ratio compression are present today in greater concentration than at any point since 1979. And the de-dollarization story, the UAE transaction, the ASEAN framework, the SCO's 97%, the IMF's documented 57.3% dollar reserve share, is the structural driver that was not present in temporary monetary stress events of 2008 or 2020. Now, the math I want you to hold. If the gold to silver ratio compresses from its current 63.1 toward its long-term historical average of 70, silver has mild upside from here. If it compresses toward the 1980 low of 17.1, the implied numbers are extraordinary. The structural question is, which scenario does the de-dollarization data support? But the petrodollar connection to silver is not a theory. It is a mechanical relationship. Dollar strength suppresses silver, dollar weakness liberates silver, and de-dollarization, gradual erosion of the mechanisms that create artificial dollar demand, is the most structural source of dollar weakness that has existed in the modern era. Let me give you the current structural picture in 5 data points. 5 things that are simultaneously true right now. Not one of them is a prediction. All 5 are documented and verifiable. Data point 1, the Silver Institute projects a 6th consecutive annual silver market deficit in 2026, approximately 67 million ounces. 6 consecutive years, demand exceeding supply every single year. Data point 2, COMEX registered silver inventories, the silver formerly committed to backing delivery obligations, stood at approximately 76 million ounces in late March 2026. Against open interest representing approximately 576 million ounces, a coverage ratio of 13.4%. Data point 3, silver hit a nominal all-time high of $121 per ounce in January 2026, the highest silver has ever been in dollars. And it has since pulled back 37% to approximately $76. The structural bull market produced a new all-time high. The pullback produced a re-entry level. Data point 4, central banks globally purchased over 1,000 tons of gold annually for 3 consecutive years, 2022, 2023, 2024. The World Gold Council data is definitive. The monetary reawakening that precedes silver's monetary bid is actively underway. Data point 5, the de-dollarization data, the UAE transaction, the 57.3% dollar reserve share, the 97% SCO local currency trade, the ASEAN framework represents the structural context that previous silver bull markets did not have. Now I want to do something I don't always do. I want to speak directly to the emotion of this moment because I think the emotion is important and I think ignoring it is a mistake. If you are 58 years old and you have watched the dollar buy less every year for the past 5 years, if you have watched your grocery bill double and your savings rate not keep pace, the de-dollarization story is not abstract. It is personal. It is happening in your kitchen. I am not telling you to panic. I'm not telling you to sell everything and buy silver bars. I am telling you that the mechanism that has suppressed silver's price for 52 years is measurably weakening, and you deserve to understand that clearly. Here is what I want you to do right now, not eventually, not this weekend, right now after this video. Step 1. Open mgroup.com. Go to markets, metals, silver, inventory. Write down the current registered silver number. That number tells you the immediate structural supply story without interpretation. Step 2. Look at the current gold to silver ratio. It is approximately 63:1 today. Understand what that means relative to the 17:1 floor that the 1980 structural monetary stress event produced, and understand what is between here and there. Step 3. Look at the de-dollarization data, not from this channel, from the IMF's COFR database, from the World Gold Council, from the BIS quarterly review. Verify it yourself. Primary sources. The data is all public and free. Step 4. Have a conversation, not with a YouTuber, with a financial advisor who understands precious metals and can evaluate the structural case in the context of your specific situation and timeline. The de-dollarization story, the UAE transaction, the 52-year suppression thesis, the structural silver setup is not a reason to panic. It is a reason to be informed. Informed is always better than uninformed, even when the information is uncomfortable. Before the final accountability update in the CTA, I want to address the Saudi question, because it is the question this video began with. And it is the most important geopolitical question in the precious metal space right now. The UAE settlement happened because the UAE is pragmatic. It saw an economic advantage and took it. Saudi Arabia is watching, and Saudi Arabia processes approximately 10 times the trade volume of the UAE. Saudi Arabia did not renew the 50-year Petrodollar agreement in June 2024. It has opened yuan oil pricing negotiations with Chinese buyers. It joined Project mBridge, the dollar bypass settlement infrastructure, in 2023. The question in the comments that this channel is built to answer is this: do you think Saudi Arabia follows the UAE into meaningful yuan-denominated oil settlement? And what is your timeline? Now the accountability scorecard. Every episode, all 5 metrics. No cherry picking. This is the episode's update. Metric $1, Forex reserve share. IMF COFR data shows 57.3% at end of 2024. The decline from 71% in 1999 continues. In this monitoring period, no reversal. The 27-year slope is unchanged. Metric 2, UN oil settlement. This monitoring period captures the ASEAN Framework Resolution of May 2025 and the SCO's documented 97% local currency trade. The yuan oil percentage remains below the 5% signal threshold, but the surrounding infrastructure is developing faster than the headline number suggests. Metric 3, central bank. Gold purchases, 3 consecutive years above 1,000 tons, 2022, 2023, 2024. World Gold Council data, definitive. The sustained signal level continues. This is the most consistent metric in the scorecard. Metric 4, gold to silver ratio. The compression from 100.1 plus in April 2025 to approximately 63.1 in April 2026 is now a fully documented trend. 37 points of compression in 12 months. Silver has already delivered 148% in this compression. The monitoring question: does compression continue toward historical averages? Metric 5, U.S. Treasury auction demand. The bid-to-cover ratio crossed below 2.3 in the most recent monitoring period signal territory. 2 metrics now simultaneously at signal level: central bank gold buying and Treasury auction demand. Summary: dollar reserve share at 57.3%, historical decline continuing. UN settlement below threshold, but infrastructure accelerating. Central bank gold buying, sustained signal. Ratio compression documented. Treasury demand at signal level. The structural picture is the most developed it has been since this channel began tracking. Now, before I go, I want to say something about the UAE transaction that I think is the most important framing of this entire video. The UAE transaction was not a statement against America. It was not an act of hostility. It was a calculation. The UAE looked at its situation, deep U.S. military ties, deep financial relationship, access to American markets, and still concluded that settling one LNG cargo in yuan made economic sense. And that calculation made by America's ally is the most important data point in the petrodollar story. Because if allies are doing the calculation and arriving at a different answer, the network effect that sustained the petrodollar for 52 years has changed fundamentally. And you stack your physical silver in your possession outside the paper system, outside the institutional framework, is the form of savings that is structurally most aligned with a world where the network's tension continues to loosen. I am not telling you what to do. I'm giving you what I wish someone had given me when I started trying to understand these forces. A clear, honest, data-supported structural framework that you can use to make your own informed decisions. Stack smart, stack with data, Stack with the understanding that the UAE transaction was not a coincidence, it was a signal. And signals, understood clearly, are the only edge that retail investors have in markets dominated by institutional knowledge. Before you go in the comments, I want to know specifically, do you think Saudi Arabia follows the UAE into meaningful yuan-denominated oil settlement? And what is your timeline? Do you think this happens within 2 years, within 5 years, or is it a decade away? Now, your answer is not just engagement. It changes how I weight the urgency of episode 7. If the community consensus is within 2 years, I accelerate the timeline on the Saudi deep dive. If the consensus is a decade, I build a longer form structural analysis. Your input is editorial direction. If the series has been useful to you, subscribe. Not because I need the metric, because episode 7 is going to go somewhere that no Silver Channel on YouTube has gone before, into the Saudi oil pricing architecture itself, into the specific mechanisms by which Saudi yuan settlement could work, and the specific barriers that remain. It is the most technically detailed episode I have built. You will not want to miss it. I'm the stat guy. The UAE started it. Saudi Arabia is the question. Silver is how you position for the answer. I'll see you in episode 7.